Imagine waking up one morning and realizing that the financial rules you built your entire life around don't work the way they used to. Your paycheck still arrives every 2 weeks. Your mortgage payment still comes out of your checking account. Your 401k balance is still sitting there. But somehow, the same salary that felt comfortable 5 years ago now feels tight. The same house costs dramatically more. The same groceries fill fewer bags. And the same amount of money sitting in your bank account buys less than it used to. Now here's the part that should get your attention. This isn't necessarily a temporary problem. We may be entering one of those rare periods when the relationship between wages, inflation, interest rates, government debt, housing, and financial assets gets fundamentally rearranged. People call these moments different things. A recession. A financial crisis. A market reset. A debt cycle. But the name isn't what matters. What matters is what happens to your money when the economic system starts changing underneath you. I'm Della, and on this channel, we simplify investing, personal finance, and wealth building so you can make smarter financial decisions without needing a finance degree. And today, we're talking about something much bigger than whether the stock market goes up or down next month. We're talking about a potential economic reset, and more importantly, how an ordinary American can prepare for it without trying to predict the exact day it arrives. Because here's the mistake almost everyone makes. They think an economic reset means one giant crash. The stock market falls. The headlines turn red. Everyone panics. Then eventually everything goes back to normal. But historically, major economic shifts rarely work that neatly. Sometimes the reset happens through inflation. Sometimes through interest rates. Sometimes through asset prices. Sometimes through wages catching up. Sometimes through debt becoming more expensive. And sometimes, the biggest change happens quietly while everyone is staring at the stock market. That's why I don't want you watching this video thinking, okay, Della, just tell me when to sell. That's not the lesson. The real question is, what happens when the things you own, the money you earn, and the money you owe stop behaving the way you expect? Because Americans are already living through an unusual combination. Households have become heavily dependent on debt. Housing remains one of the largest expenses for millions of families. Credit card balances can carry extremely expensive interest rates. Car payments have become a major part of monthly budgets. At the same time, millions of Americans are investing through 401(k)s, IRAs, brokerage accounts, and employer retirement plans. So your financial life is connected to the economy from almost every direction. You are simultaneously a worker, a consumer, a borrower, a taxpayer, and, if you own investments, a capital owner. And those different roles can benefit from completely different economic conditions. Think about a typical American household. Let's call her Sarah. Sarah earns $78,000 a year. She has a mortgage. She contributes 8% to her 401k. She has about $12,000 sitting in savings. Her car payment is $520 a month. Her health insurance comes out of her paycheck. She buys groceries every week. And she's doing what everyone tells her to do. Work hard. Save money. Invest for retirement. Avoid unnecessary spending. Sarah isn't irresponsible. She's actually pretty disciplined. But here's the problem. If inflation rises faster than her income, Sarah becomes poorer in purchasing power terms even though her bank account keeps getting bigger. If mortgage rates rise, borrowing becomes more expensive. If stocks fall, her retirement account can temporarily lose significant value. If taxes change, her take-home pay changes. And if the economy weakens enough, her employer may slow raises or reduce hiring. Sarah doesn't need to understand every Federal Reserve announcement to be affected by all of this. She already is. And that's why the phrase economic reset can be misleading. The reset doesn't necessarily arrive as one dramatic event. It can happen through hundreds of small changes that eventually produce a completely different financial environment. And there is one force sitting behind almost all of them. Debt. America's economy has been built around borrowing for decades. Consumers borrow for homes. Students borrow for education. Businesses borrow to expand. The government borrows to finance spending. Investors borrow to increase returns. Debt itself isn't automatically bad. A mortgage can help you buy an appreciating asset. A business loan can finance productive expansion. Student debt can sometimes increase earning power. The problem begins when the cost of servicing that debt rises faster than people's ability to pay it. And this is where interest rates become incredibly important. Imagine you bought a house when mortgage rates were extremely low. Your monthly payment might feel manageable. Now imagine being a first-time buyer entering the market when rates are significantly higher. The house may be the same. The neighborhood may be the same. Your salary might even be similar. But the monthly payment can be completely different. That means the price of an asset isn't the only thing that matters. The price of money matters too. And when the price of money changes, almost everything gets repriced. Stocks, bonds, real estate, business valuations, credit, consumer spending, and eventually, even the labor market. This is why investors sometimes make a dangerous mistake during economic transitions. They look at the stock market and assume the economy is healthy because the index is rising. But the stock market isn't the entire economy. It's a market for ownership in businesses. Those businesses can become more valuable even while the average household feels financially squeezed. And that creates one of the strangest situations in personal finance. You can have a rising retirement account while simultaneously feeling poorer. You can own an index fund that is performing well while your grocery bill keeps climbing. You can see headlines celebrating economic growth while your rent renewal makes you question your entire budget. There is no contradiction. Because financial markets measure the value of assets. Your household budget measures the cost of living. Those are two different scoreboards. And during an economic reset, the distance between those scoreboards can become extremely important. Now here's where this gets interesting for investors. Imagine you have $100,000. You could keep the entire amount in cash. You could invest the entire amount in stocks. You could buy real estate. You could hold bonds. Or you could build a diversified combination of assets. Each choice exposes you to a different kind of risk. Cash protects you from market volatility but exposes you to inflation. Stocks can grow purchasing power over long periods but can fall sharply. Bonds can provide income and stability but react strongly to changes in interest rates. Real estate can provide shelter and potential appreciation but comes with financing, taxes, maintenance, and concentration risk. There is no magic asset that wins in every economic environment. And that is precisely why preparing for a reset doesn't mean trying to find the one investment that will make you rich. It means building a financial system that can survive multiple possible futures. Because nobody knows exactly what the next decade will look like. Maybe inflation cools dramatically. Maybe interest rates stay elevated. Maybe productivity accelerates because of technology and artificial intelligence. Maybe unemployment rises. Maybe housing prices stagnate for years. Maybe stocks continue climbing. Maybe we get a brutal bear market. Maybe we get several of these at the same time. The investor who needs one specific outcome to happen is taking a huge risk. The investor who can survive several outcomes has something much more valuable: time. And time is one of the most powerful advantages an ordinary investor can have. Because when you aren't forced to sell an investment to pay the mortgage, you don't have to turn a temporary market decline into a permanent financial loss. When you have an emergency fund, a job loss doesn't automatically become a credit card crisis. When you have manageable debt, higher interest rates don't destroy your monthly cash flow. And when you consistently own productive assets, you don't have to perfectly predict which economic regime comes next. You participate. That's the difference between forecasting the future and preparing for it. And this is where the idea of a once-in-a-lifetime reset becomes much more useful. Don't ask, exactly when will the crash happen? Ask, what would happen to my household if inflation stayed high? What would happen if stocks dropped 30%? What if I lost my job for 6 months? What if mortgage rates stayed elevated? What if my salary didn't increase for 3 years? What if the market doubled while my income barely moved? Those questions aren't predictions. They're stress tests. And before this series is over, we're going to use them to build something much more useful than a scary economic forecast. We're going to look at the major forces that could reshape American wealth, debt, inflation, interest rates, asset ownership, taxes, retirement accounts, and the changing relationship between labor and capital. Because the biggest opportunity during an economic reset isn't necessarily predicting what collapses. It's understanding what survives. And even more importantly, who owns it when the reset is over. That's where this story gets much more interesting. Because throughout American history, economic transitions have created enormous financial winners. But they have also created people who spent decades working harder without building meaningful wealth. The difference wasn't always intelligence. It wasn't always income. And it definitely wasn't luck alone. Very often, it came down to one decision. Did their money work alongside them, or did they spend their entire life working for money? And that is the question we're going to tackle next. Now let's get to the part most investors misunderstand. An economic reset doesn't necessarily destroy wealth. It changes where wealth flows. And that distinction matters enormously. Think about what happened to your grandparents' generation. They lived through periods of high inflation, changing interest rates, major recessions, housing booms, and stock market crashes. Some lost money. Others built fortunes. The difference wasn't that one group could predict the future. The difference was what they owned when the environment changed. That's the first principle I want you to remember. Economic transitions punish concentration and reward adaptability. If your entire financial life depends on your paycheck, you're exposed to the labor market. If everything you own is in your house, you're heavily exposed to real estate. If everything is sitting in cash, inflation becomes your enemy. If everything is in stocks, a market crash can hit your net worth hard. And if you're carrying expensive credit card debt, rising rates can quietly transfer your future income to someone else's balance sheet. This is why wealth building isn't simply about finding the highest return investment. It's about creating multiple layers of financial protection. Let's make this practical. Suppose you earn $80,000 a year. Your first job isn't to become a stock-picking genius. Your first job is to make sure one financial emergency doesn't knock over the entire structure. That means keeping a reasonable emergency reserve. Then eliminate high-interest consumer debt. Then take advantage of tax-advantaged accounts such as a 401k or IRA when appropriate. And if your employer offers a 401k match, don't casually leave that money behind. That's one of the rare situations where the financial system is effectively offering you additional compensation for saving. After that, you want ownership. Not just savings. Ownership. Because savings protect your short-term stability. Ownership gives you exposure to long-term economic growth. When companies become more productive, shareholders can participate. When businesses generate profits, owners participate. When the economy expands over decades, productive assets can compound alongside it. And you don't need to own the next Apple. You don't need to predict which artificial intelligence company wins. You don't need to sit in front of 6 monitors watching candlestick charts. For many Americans, broad diversification is far more important than trying to identify the next big winner. But there's another problem. Even investors who own assets can make one massive mistake during a reset. They panic at exactly the wrong time. Imagine you have $150,000 invested for retirement. A major downturn hits. Your account suddenly falls to $105,000. That's a $45,000 decline on paper. Your instinct says, get out. So you sell. Then 6 months later, the market begins recovering. You hesitate. Then it rises another 10%. You still wait. Eventually, you buy back in because now everyone is talking about the recovery. You just sold low and bought higher. The market didn't destroy your wealth. Your reaction did. This is why your investment strategy has to be designed before the crisis, not during it. And there is an important reason economic resets create this psychological trap. When prices fall, the news becomes louder. Every headline sounds urgent. Your neighbor says they're selling. Your coworker says they're moving everything into cash. Social media tells you the financial system is collapsing. Meanwhile, your retirement account is flashing red. At that moment, your brain doesn't care about a 20-year investing plan. It cares about avoiding pain today. That's normal human behavior. But successful long-term investors build systems specifically to protect themselves from that instinct. Automatic contributions. Diversification. Emergency savings. Manageable debt. Appropriate asset allocation. And most importantly, a time horizon. Because if you're investing money you need next month, you aren't really investing. You're gambling with money you need. But if you're investing money for retirement 20 or 30 years from now, a temporary decline can become something completely different. It can become an opportunity to buy productive assets at lower prices. That's one of the biggest psychological shifts you need to make. Stop asking, is the market going down? Start asking, do I have enough financial stability to keep investing if it does? That question is far more useful. Now let's talk about another force that could become extremely important during this reset. Inflation. Most people think inflation simply means higher prices. But from an investor's perspective, inflation is also a war against idle cash. If your money earns 1% while your purchasing power declines faster than that, you're losing ground even though your account balance is technically increasing. That's why a person can feel financially responsible while quietly becoming poorer. They save $10,000. Then another $10,000. Their account reaches $30,000. They feel safer. But if the purchasing power of that money keeps declining, the number on the screen doesn't tell the whole story. This is why wealthy households don't think only in dollars. They think in purchasing power. The question isn't, how many dollars do I have? It's, how much can those dollars actually buy? That changes the way you think about investing. You start looking beyond checking accounts and savings balances. You start thinking about businesses, real estate, bonds, retirement accounts, and other productive assets appropriate for your situation. Because during a major economic transition, the value of the dollar, the cost of borrowing, and the price of assets can all move differently. And that's where the next piece becomes critical. Because if inflation changes the value of your money, and interest rates change the price of money, and markets change the value of your investments, then there is one institution sitting in the middle of this entire system, the Federal Reserve. And understanding what the Fed can and cannot control may completely change the way you look at the next economic cycle. Because the next reset may not begin with a stock market crash at all. It could begin somewhere much quieter. In the bond market. Remember where we left off? The next economic reset may not begin with a stock market crash. It could begin in a place most Americans rarely watch. The bond market. Here's why that matters. When the Federal Reserve raises interest rates, borrowing becomes more expensive. Your mortgage gets affected. Car loans get affected. Credit cards get affected. Businesses pay more to borrow. And suddenly, money itself becomes more expensive. But there's another side to this. Higher interest rates can make bonds and cash-like investments more attractive. So money starts moving. And when trillions of dollars start moving between cash, bonds, stocks, and real estate, asset prices can change dramatically. This is why investors shouldn't look at the S&P 500 in isolation. The bigger question is, where is capital flowing? Imagine two American families. The first family has $20,000 in credit card debt at a high interest rate. The second has $20,000 sitting in savings and investments. A higher rate environment affects them completely differently. For the first family, higher rates are a financial emergency. For the second, higher rates might actually create new opportunities to earn income on cash and bonds. Same economy. Completely different experience. That's the hidden lesson of an economic reset. Your financial position determines whether the change feels like a crisis or an opportunity. And this is exactly why debt deserves so much attention. If you're carrying high-interest consumer debt, don't worry about finding the next 10x stock while that debt is compounding against you. A guaranteed high-interest expense can overwhelm a lot of investment returns. Getting financially stronger isn't always exciting. Sometimes the smartest wealth-building move is incredibly boring. Pay off expensive debt. Build your emergency fund. Capture your employer's retirement match. Then invest consistently. But there's another force that could make the next decade especially interesting. Technology. Artificial intelligence and automation could dramatically increase productivity. If companies can produce more with fewer resources, corporate profits can rise. But there's a question Americans need to ask. Who captures those gains? The companies? The shareholders? Highly skilled workers? Or everyone through higher productivity and wages? Nobody knows the final answer. And that's precisely why you shouldn't build your financial future around one prediction. Instead, own pieces of the system. If businesses grow, your investments can participate. If technology creates new industries, diversified investors can participate. If inflation falls, your purchasing power improves. If rates decline, certain assets may benefit. You're not trying to predict which future wins. You're positioning yourself to survive several possible futures. And this brings us to perhaps the most important idea in this entire video. During an economic reset, income matters, but ownership matters differently. Your paycheck pays today's bills. Your investments can help pay tomorrow's bills. And the earlier you turn a portion of your income into productive assets, the more time compounding has to work. Let's say you invest $500 every month. At first, it doesn't look impressive. After 1 year, you've contributed $6,000. After 5 years, you've contributed $30,000. But eventually something changes. Your money starts producing returns. Then those returns produce additional returns. Eventually, your portfolio can begin generating more growth in a year than you personally contributed. That's the point where investing stops feeling like saving. It starts feeling like ownership. And ownership is exactly what matters when the economic rules change. You don't need to be rich today. You need to gradually build a financial position that doesn't depend entirely on your next paycheck. Because if a reset arrives, the people with the most flexibility won't necessarily be the people with the biggest salaries. They'll be the people with manageable debt, cash reserves, multiple income sources, and assets that can compound over time. That's the goal. Not predicting the crash. Not predicting the Fed. Not predicting the next hot stock. Building a household that doesn't break when the prediction is wrong. And in part 4, we're going to bring all of this together. We'll look at what an ordinary American can actually do before the next major economic shift, including the money order I would follow, what I'd prioritize in a 401k, how I'd think about cash, debt, and investments, and the one mistake that could leave you financially exposed even if the economy never crashes. Because the real reset isn't about what happens to the economy. It's about whether your financial life is ready when it does. So, what should you actually do? Not panic. Not sell everything. And definitely not wait for some perfect reset day to arrive. Because nobody knows when the next major economic shift will happen. What you can control is your financial position before it happens. Start with the basics. Step 1. Build liquidity. Keep enough emergency savings to handle the unexpected, a job loss, medical bill, major car repair, or temporary income disruption. Your emergency fund isn't there to make you rich. It's there to keep you from selling investments at the worst possible moment. Step 2. Attack expensive debt. If you're paying extremely high interest on credit cards, getting excited about a 7% or 8% investment return doesn't make much sense. Your first investment may simply be getting rid of the financial leak. Step 3. Use the tax advantages available to you. If your employer offers a 401k match, take advantage of it when appropriate. Then consider using tax-advantaged accounts such as an IRA or other retirement options that fit your situation. The goal isn't to avoid taxes illegally. It's to understand the rules and stop voluntarily paying more than necessary. Step 4. Own productive assets. Once your foundation is strong, consistently invest for the long term. For many Americans, that can mean diversified stock market investments through retirement accounts or brokerage accounts. Don't invest money you'll need next month. Invest money that has time to compound. And here's the most important step. Don't build your financial plan around a prediction. You don't know whether the next decade brings a boom, recession, inflation spike, market crash, or something nobody has predicted yet. Neither do I. But we don't need to know. If your financial system can survive several different outcomes, you've already gained an enormous advantage. Think about it this way. You can't control the Federal Reserve. You can't control inflation. You can't control the stock market. You can't control Washington. You can't control whether your company gives you a raise. But you can control how much you spend, how much you save, how much expensive debt you carry, how much you invest, and how much of your future income becomes ownership. That's the real economic reset. Not one dramatic day when the financial world suddenly changes. It's the gradual shift from depending entirely on your paycheck to having your money work beside you. Because imagine reaching retirement with a paid-off home, manageable expenses, a diversified portfolio, retirement accounts working in the background, and enough cash to handle emergencies. An economic downturn might still hurt. Inflation might still annoy you. Markets might still crash. But your entire life doesn't collapse with them. That's financial resilience. And ultimately, that's what wealth is supposed to give you. Not a fancy car. Not a giant number on a screen. Options. The option to leave a job you hate. The option to handle a family emergency without panic. The option to retire when you want. The option to help your children. And eventually, the option to wake up knowing that your future doesn't depend entirely on your next paycheck. So if this economic reset really is coming, don't waste your energy trying to guess the exact date. Build a financial life that is ready whenever it arrives. Because the biggest mistake isn't being wrong about the economy. It's having a financial plan that can only survive if you're right. And remember, you don't need to predict the future to build wealth. You just need to be prepared for it.